Alibaba reported results today, and there's a lot to get through in this first look, so let's get right into it. You're watching More Money, let's get it. What's up, guys? And I'm really sorry for making this so late. I had a super busy day today, so let's get right into it. So you can see here that when the markets opened this morning, because of the fears of the global conflicts, Alibaba actually opened at around $100 per share and then quickly regained back to about $108 per share and then just whipsawed. And as of right now, it's around midnight Eastern time. Right now, it's sitting at around $110 per share. So overall, the results really didn't impact the market sentiment, at least to the valuation of the shares. And I think that makes a lot of sense. And as we go through it, you'll see why. Now, I just wanted to start off with the number of customers that are using the platform. This thing has grown to 1.3 billion annual active users globally. That's a 19% increase year over year. That's not nothing, guys. And so I think that's pretty incredible. The fact that they achieved 19% year over year when they already have a billion customers. So very interesting to see. As you can see, a big part of the growth was in the local consumer services that grew at 26%. And of course, the largest part of the growth was in the international, where they grew 37%. But even in China alone, you can see that they grew 15%. So all areas are firing very well right now. And just looking at the results, going into their year-over-year revenues for the 3 months, you can see that China commerce as a whole grew at 7%. And this was largely being dragged down by the customer management segment, which is actually down 1% year over year. And if you guys remember, that customer management segment is where Taobao and Tmall sit. So they're real legacy business. And what's very exciting to see is that their direct sales and other segments, so that would include like Fresh Hippo and those types of businesses, they're up 21%. And of course, wholesale is up 10%. And just comparing China Commerce Retail to what my medium-term expectations are, I would expect this segment on average over the next 5 years to grow at approximately 18.4%. Now remember, this is the segment that's been growing at around 40% a year up until about this year, where the growth has started to slow. And if you guys remember, I was forecasting it too slow. But I thought 18.4% growth in this segment for the next 5 years was relatively conservative. So, right now on a 9 months basis, it's running at 22%, which is okay. But the latest month is showing signs of real slowdown, which reflects what I've been talking about earlier on this channel, where there are some very real risks with the Chinese customer slowdown right now. And a lot of that is because of unemployment that people are not considering, that is really hitting the economy. And part of the reason why they're having unemployment is because of a couple of major industries that the government really cracked down on. One is the real estate and the other is the after-school tutoring. And I'll link to the video where I covered all of that at the end of this video. Now, just moving into the next slide, into China commerce, you can see overall, as we just mentioned, overall revenues up 7% quarter over quarter. And the customer management segment is down 1%. So that 21% for the direct sales and others, it looks like part of the reason why it's up is they're reporting that the percentage of new customers in less developed areas continues to increase, which reflects their success in broadening their product offerings to meet diverse customer demand. And that makes a lot of sense because that's largely what they were focusing on with their investor day. They do want to develop those less developed areas in China. That's their next leg of growth. But as they mentioned in their business and strategic updates, they are still seeing slowing market conditions as well as competition. And I just want to point out what they continue to list first as opposed to second. Everyone keeps saying that it's competition that's hurting them, and I'm not saying that it's not competition that's hurting them, but what I am saying is that they continue to list slowing market conditions first. So this goes back to that whole real estate issue that's causing the overall customer slowdown in the country. And so I really want to point out that there are some real risks in China. We don't know how this sort of pans out over the medium term. I do think long-term wise, this is a good investment because long-term, the Chinese consumer will be sound, but I could be wrong. The demographics are starting to turn against me, right? Because in this decade, China is going to start seeing their population growth decline as well. So we'll see how this works. We'll see how these geopolitical conflicts impact China as well. They have said that they do not support what's happening right now. They want to achieve diplomatic solutions to the conflicts. And I think part of that is because they got to maintain their relationships with the US. So we'll see how this progresses. Now, just quickly into their newer brands, it looks like for Taobao deals, for 12 months ended in December 31st of 2021, they had 280 million annual active customers. And this is up from 39 million from the prior quarter. So that's insane, the level of growth that they're seeing. And they're focusing on this. So it's really exciting to see them become successful here. Now, with Tao Sai, it looks like they have achieved GMV growth of 30% quarter over quarter. And what's interesting is they're mentioning that Tao Sai is driving higher penetration into the annual active customers' purchases of food, grocery, and fresh produce, which enhances their purchase frequency and stickiness onto their platforms. At the same time, the unit economics per order continues to improve, benefiting from higher regional order density and improving gross margin from enhanced supply chain capability. So once again, they're going right after what they said they were going to go after in their Investor Day presentation, which is that grocery segment. Nobody else is competing against them here. So with China commerce overall, the real story is there is a slowing Chinese consumer, which is weighing on their Taobao and Tmall businesses in domestic China. So we'll see how that sort of rolls out. I really would like to see that customer management segment start to grow again. So fingers crossed that it continues to happen. We don't know. We'll see how this rolls out, but it's definitely heading in the wrong direction, guys. Now, moving into international commerce, you can see that overall international commerce retail grew at 14% and international commerce wholesale grew at 29%. So overall 18%. What was very surprising to me was that Lazada grew again at 52%. So such a high amount. And Trendyol, I didn't expect Trendyol to grow. I thought that the impacts in Turkey with their currency crisis would cause the business to slow down, but it really hasn't. Trendyol has grown 49% quarter over quarter. What was interesting, however, is that Europe added a value-added tax on cross-border parcels below 22 euros in value. So that sort of offset their increase in revenue a little bit. So we'll see how this plays out. Now, overall, I'm forecasting the international segment to grow in the medium term in between 15 and 20%. So they're with 18%, they're largely on track. So nothing out of the ordinary here, nothing exceptional. I did say last quarter that the really exceptional results in international were a bit highly unusual. And so I didn't take up my expectations for revenue growth in this segment. And this quarter, you can see they've kind of just fallen right back to where I believe they should be. The only question I have is how much merchant support is going in to help Lazada increase those additional sales, and how much merchant support is going in to help Trendyol with those additional sales. So I will cover that more in the deep dive that'll be coming subsequent to this first look. But yeah, that'd be interesting to look into. Moving on to the local consumer services. It looks like overall the revenue is up 27%. And of course, guys, this includes Eli.me. That would be like your Uber Eats platform. It also includes Amap, Fliggy, and Tawaxiana. I can't really pronounce that. Now, the home, like the delivery to your home businesses are Eli.me and Tawaxiana. The one concern that I have with these two businesses is that the Chinese government recently asked these platforms to reduce their fees. And so I think that going forward, you can have some profitability issues. You've already seen Meituan's share price collapse after this announcement by the Chinese government. And so we'll see how this plays out. And once again, my suspicions are that the reason why they're asking these platforms to make the home delivery costs cheaper is because the country may be experiencing more unemployment than it's letting us know about, I would say. And so one of the ways to allow for people to have some work while they search for more long-term solutions for work is have them go into the gig economy. I've always said Uber Eats And those types of things are really good if you get laid off, because at least you can continue paying your rent or your mortgage while you find another full-time job. There are some people on Uber Eats in North America that are making $8,000 a month. Obviously, they're working 12 hours a day every day, but you can very easily do around $4,000 or $5,000 a month if you work really hard while you're interviewing for new jobs. So I understand why you'd want to push people into the gig economy while they're searching for new work. I get it, but it's going to hurt Ellie.me over at least the short term. Now, the two destination type apps are apps that draw the customer to the merchant, and those are AMAP and Fliggy, and I just need to learn more about those businesses before I comment on them, and I'll do a little bit more work before I comment on them in the full review that I'll do subsequent to this video. Now with Cainiao, their revenue is up 15% year over year. And what's interesting here is if you actually add back in sort of the inter-segment eliminations, their revenue is actually up 23% year over year. But what's causing their revenue to increase? So they've told us that Cainiao continues to expand its global infrastructure by strengthening its end-to-end logistics capabilities, including e-hubs, line hauls, sorting centers, and their last mile network. And I think the next generation business right here is solving that last mile network problem. And so the number of Cainiao posts in rural areas more than doubled year over year as of December 31st, 2021. So what that tells me is those Cainiao posts are really going to go a long way into helping Taobao deals, and especially Tao Sai Sai. I think that those two businesses work together in this ecosystem, and we'll continue to see growth here. Now, 15% year-over-year revenue growth for Cainiao is exactly on what I'm forecasting for their medium-term growth. My model is saying that I'm looking for 15%, so nothing more to say there. So let's move on. Now the jewel in the Alibaba cap, the cloud business grew at 20% year over year. But what was interesting about this business is that they said that their results were partially offset by the continuing impact of a top customer's decision to stop using their services for its international businesses due to non-product related requirements. So essentially, I believe that this is ByteDance, the owner of TikTok, and there might be some data security issues, and so they might have decided to use a North American provider. I understand that. What I find that's a little concerning is that they're starting to see slower demand from customers in the internet industry, such as online entertainment and education. This is the first time we've seen real weakness in the cloud business. The other thing is revenue only growing at 20% year over year. This is compared to competitors like Microsoft. Last quarter, they grew at 50% year over year. I'm forecasting the cloud business to grow at 25% annual average growth over the next 5 years. So 20% this quarter is not far off of that, but I really thought that 25% was on the low end, and I was really hoping for Alibaba to always sort of surpass that. But once again, this is just one quarter, so we'll see how this plays out going forward. But I want to see improved demand from the internet industry. I think the internet industry leads the charge into the cloudification, and then the other industries follow. I do like that they're diversifying the types of businesses that are coming onto the cloud, but once again, we got to get going here. Now, the other segments I'll cover in the full review. One thing I did want to mention is that they purchased $1.4 billion in shares in the quarter, which essentially reflects, 0.5% of the float. So it's really nothing. But what I wanted to show you in this slide here is that you can see that at the end of 9 months, their free cash flow is around $17.8 billion. So effectively, you can say that this company will finish with somewhere around $20 billion to $25 billion in free cash flow for the year. So that's their free cash flow generating capability. And also that free cash flow is growing. But let's just assume that it stays stagnant at 20 to 25 billion free cash flow every year. What that really reflects, if you look at their market cap's $300 billion right now. So that reflects a 12 to 15 times multiple on their free cash flow. So it's really cheap on its own. But the one thing that I do want you to focus on is that these guys have $75 billion in cash, and $40 billion in equity investments. If you take that out of the valuation, you have a $185 billion market cap. That $185 billion divided by that 20 to 25 billion in free cash flow, you're looking at a business that's trading for 7.4 times to 9.25 times free cash flow. It's insanely cheap. And like, I would say it's almost ludicrously cheap at around $100 per share. So those of you that are buying this thing at $100 per share, assuming that you are addressing the portfolio diversification requirements in your portfolio, I never would say I would never tell anybody to go all in on this thing. But assuming that you're addressing the portfolio diversification requirements, buying this thing at $100 a share when the market cap's approximately $300 billion, you're getting a steal. Like, is Alibaba really a company that should be selling at between 7.5 and 9.25 times earnings? I don't think so. I think this is an insane opportunity. Now, it gets even nuttier. Let me show you this, guys. So from here, you can see that the China commerce business is the only business that's achieving positive adjusted EBITDA. The rest of these businesses that they're investing in, these businesses are going to generate income in the future. You can see Alibaba Cloud is already reflecting a little bit, but all of these other businesses are not generating free cash flow right now. So they're loss leaders. If you were to just cut off all those businesses, which I obviously recommend you don't, but if you were just to cut off all those businesses, the free cash flow would be closer to around $28-29 billion a year. And so if you were to take that $28 or $29 billion a year and use that as your denominator and put your 185 billion, which is the 300 billion less the cash and the short and the equity investments, this thing is trading at 6.4 times free cash flow. And even if you were to just do the 300 billion divided by the 28.8 billion, which was what I expect them to earn on just that one China commerce segment alone, this company is trading at 10.4 times free cash flow. So without even considering cash. So what you have is an insanely cheap business, in my opinion. 6.4 times free cash flow. And if you consider all the other businesses, you're looking at something around 7.4 to 9.25 times free cash flow. So once again, make sure that you are addressing your diversification requirements for your portfolio. But this thing is just getting nutty with how cheap it's getting. And so I'm going to really start thinking about deploying more capital into here. I think I'm at around 15% right now, which is really high, but it is coming down as I'm putting more cash into the portfolio in 2022. And so I think I might just maintain that 15% exposure throughout 2022. No guarantees, of course. We'll see what I end up doing, but I'm still a huge bull on Alibaba. And I'll break down the other segments in the more fulsome analysis. Now, also, guys, I'm going to be building a new model on Alibaba at the end of Q4, and I will provide that model to the Patreons. And so everyone who just watches the videos, you guys will continue getting this model, but the more detailed model that will allow you to see sort of the nuances, you'll get that at the $5 Patreon tier. Also, guys, this Saturday, I'm having my monthly call with the Patreon. So if you want to jump on the monthly call with us, I highlighted, I would say 5 or 6 stocks that are extremely cheap right now. And I gave it out to my Patreon folks earlier this week. And we're going to go through a huge list. I think there's like 20 or 30 names on this list on Saturday. And so if you want to be a part of that, the link to the Patreon is in the description below. And hey, you know what? If you join it and you don't like it, send me a message and I'll refund your money for that first month. Also, if you haven't seen the video on the risks in the Chinese economy, I really encourage you to do that. And you can get to that link right here.